Welcome back. Today we're going to pick up for the third lecture in Chapter 15 for stockholders' equity, and we're going to cover preferred stock and stock dividends. Let's go ahead and get started. First, just to highlight what a preferred stock is, it represents a special class of shares that possess certain preferences or features not possessed by common stock. We're going to discuss several of these features uh, throughout this chapter and this lecture today. And these features are what makes it different than common stock issuances. First, the preference as to dividends. With preferred stock, you are generally guaranteed to receive a dividend. There are a few restrictions that could be in place, but for the most part, you will always be guaranteed a certain amount of dividend that is known in advance, often is reflected as a percentage of par. As you can see in this example, a 10% dividend on a share of $10 par value preferred stock equals $1 dividend per year. You will know this in advance for preferred shares. This is a key difference between preferred stock and common stock. Common stock, you are not guaranteed dividends whatsoever. The next one here regarding the preferences to dividends is cumulative preferred stock. And what this is dividends earned but not declared accumulate and must be paid in full before common stock dividends, also referred to as dividends in arrears. What this essentially means is that if you own cumulative preferred stock, any dividends that are paid, you must be paid your rightful amount before any other dividends are paid to common stockholders. And the example we have here, on January 1st, 2013, Investor A purchased 100 shares of $10 par cumulative preferred stock that pays an annual dividend equal to 10% of par. And I've given you the math there as $1 dividend annually per share. In 2013 and 14, the company did not issue or declare any dividends. On December 1st, 2015, they declared a dividend to be paid on 12/15 in the amount of $500. So, while you are guaranteed a dividend with preferred stock, you do not always get that dividend the same year. You do not always get a dividend every year, is what I should say. Excuse me. Therefore, when the company finally does pay the dividend, you get to accumulate all of those years in which they did not pay the dividend. And this is only if you have cumulative preferred stock. Not all preferred stock is cumulative preferred stock, but it is one type of preferred stock. So, going through this example, we will say how much of the $500 dividend is paid to investor A, and then how much is left over to the common stockholders. Remember, you must account for all years in which the dividend was not paid previously. So first, let's calculate the dividend per year, which I gave it to you in the example, and times the 100 shares equals $100. However, in an example on a test or on a quiz or homework, you may not be given all of that information. The question may specifically read that the stock pays an annual dividend equal to 10% of par. And then you would be given what the par value amount is. But it may not necessarily spell it out as I did in this example. So now that we know what the dividend per year would be for those 100 shares that Investor A owns, we need to figure out how many years does the company need to pay. And given our example, the company needs to pay 3 years because they did not pay any dividends in 2013 and 2014. Therefore, they have to pay the full 3-year amount in 2015. If, for example, the company had paid dividends every year, then the amount they would pay in 2015 would only be equal to 1 year. Therefore, the amount that is paid to investor A is going to be $100 times the 3 years that he is owed, so $300, leaving the remaining $200 left to the common stockholders. The key thing to remember with cumulative preferred stock is that they are for dividends earned but not yet declared and paid. Therefore, if the company does not declare dividends in a given year, you begin to accumulate those dividends, and when they finally do declare and pay dividends, they must pay you in full before they pay the common stockholders. That is a key takeaway to note, and this gets back to, as we discussed in the first lecture for this chapter, how preferred stock has a better preference to the assets in liquidation than common stockholders. This is also another one of those features where you can see that preferred stock has a preference before the common stockholders. Next, let's move on to participating preferred stock. What you need to know with participating preferred stock is that in addition to the dividends that are prescribed for the preferred stock, it also allows the holders of this preferred stock to share in the common stock dividends. So given our example above, if the investor A had participating preferred stock, they would have received a dividend in the year that the company paid it, but they also would have been eligible to receive dividend equal to the amount that is being awarded to common stockholders. So therefore, they would not only get a dividend on the preferred stock that they own, but they would also be eligible to receive a dividend associated with what's being paid to the common stockholders. So with participating preferred stock, you would be getting essentially two type of dividend payments, which is, a preferable thing. However, these features do factor into the pricing of preferred stock, and since you would potentially be able to receive multiple dividends, they typically will cost you more money to buy these type of preferred stock. Few other things I just want to highlight real quick in terms of the preference as to dividends we just discussed. Make sure that you can calculate the amount of the dividend, given that it may not say this in the example. It may just say essentially this, and you need to know that you need to calculate 10% of par to get the annual dividend amount. Now, let's move on to a few other features I just want to highlight really quick. As you can see here in number 2, preference as to assets in the event of liquidation. So this is what we talked about a little bit in the common stock section, but for preferred stock, they are second in line after creditors. And so it goes creditors, preferred stockholders, and then common stockholders. The next one, convertible into common stock. The key to note here is that there is no change to equity when this happens. You essentially take the preferred stock that you have and it is transferred into common stock. Therefore, on the company's books, they would essentially remove the preferred stock from the books, debit entries to preferred stock, and then increase the credit balance of common stock, which would be adding common stock. Additionally, other features are that they're callable at the option of the corporation. This is a feature that allows the corporation to call back the preferred stock and reissue preferred stock if there are interest rate changes in their advantage. And then a few restrictions that apply to preferred stock. Often preferred stock has restrictions to voting, whether they are cumulative or participating. Not all features that we just previously discussed are included in all preferred stock issuances. Often there are restrictions to the rights that are included in these type of preferred stock issuances. So some may have voting rights, most do not, but some may be cumulative or some may be participating. But it is unlikely that all three of these features would be included in one specific preferred stock issuance. Now let's go on to discuss a little bit about the accounting for and reporting of preferred stock. The reporting and accounting for preferred stock is very similar to common stock, as we discussed in the first lecture for chapter 15. I will go through an example here in just a second that highlights it. First, I would like to note there is a type of preferred stock that is referred to as redeemable preferred stock. And the key thing I want you to note here is that if it is mandatory redeemable preferred stock, the company has to treat it as debt. But if it is optional redeemable preferred stock, they treat it as equity. That is all that you need to know for redeemable preferred stock. I just want you to make sure that you understand that if it is mandatory, it is debt, and if it is optional, it is equity. So if you can keep those straight, you should be able to answer any question that may arise on the homework or the exam or a quiz. So the example here is a very basic calculation of the accounting for preferred stock, and is very similar to what we did with common stock. So as we can see in our example, we have 1,000 shares of preferred stock, and we received $50 per share. Therefore, we received $50,000 in cash, which is the 1,000 shares times the $50 per share. Similar to common stock, the preferred stock account, this goes in at par. And this goes in as the fair market value less par for additional paid-in capital. You have to make sure that you understand that concept and keep those straight. So as we discussed in the common stock section, this is treated similarly between both common stock and preferred stock. The capital stock account, the preferred stock count, goes in at par value, with the additional paid-in capital goes in as the difference between the fair market value and the par. Therefore, we know that we issued 1,000 shares at $10 in par. Therefore, we're going to increase the preferred stock balance by $10,000. And therefore, to balance our formula here, assets equals liabilities plus equity, we need to recognize $40,000 in additional paid-in capital, which represents $50, the fair market value, minus par of 10 gives you 40 times the 1,000 shares for $40,000. It is very key, and I will continue to stress this, that you understand that the capital stock accounts, which are the preferred stock and the common stock, are reflected at the par values, and then that the difference between fair market value and par is reflected in the additional paid-in capital. That is a key thing to take away from this section, and will apply to a lot of the examples and problems that you may see on a homework assignment, a quiz, or the exam. That is it for preferred stock. As you can see, there's not a lot to preferred stock. The accounting for it's very similar to common stock, but before we move on to dividends, I just want to echo again a few of the key things that we just discussed. One, you need to make sure that you can calculate this dividend given minimal information such as this, and knowing that that equals a $1 dividend. Most problems you receive will have just expressed that it is a 10% of par dividend, and you would need to calculate what that dividend is. Also, for cumulative preferred stock, remember that it is dividends that you earn but that have not been declared by the company, and that you accumulate and must be paid in full before common stock dividends. Therefore, if you own cumulative preferred stock, you must receive your full balance before the company distributes common stock dividends. For participating preferred stock, all that you need to remember for this is that in addition to the dividend that you may receive for the preferred stock, the holders of participating preferred stock also can share in the common stock dividends. Convertible into common stock. This goes back to what I've previously mentioned about you need to make sure that you understand how these transactions are impacting the equity accounts, and making sure that you understand that, because often you will receive questions that will ask, not only do the transaction and the calculations, but also what's the change to stockholders' equity. And for this example, for preferred stock, you note that there's no change to equity because it's merely a transfer of the balance from preferred stock to common stock. All right, moving on now. Let's discuss dividends. Excuse me one moment, I'm going to take a drink of water. All right, moving on. for dividends. So what the company pays dividends with, it is reflected of what's in their retained earnings. However, few firms pay out dividends in amount equal to their available retained earnings, and there are a few key reasons for this. Your retained earnings does not equal your cash flow. Therefore, you must have cash available to pay the dividends. So just because you have $100 in retained earnings, if you don't have $100 in cash to pay the dividend, you cannot pay your entire retained earnings out as dividends. Creditor restrictions and state corporation requirements. As we discussed at the beginning of this chapter, there are state laws that prohibit you from doing certain transactions as a corporation, one of which often refers to the fact that a company cannot dividend its entire retained earnings. Part of this is for the corporation to build up a cushion against potential future losses, and then also so they can retain assets to finance the growth of their company or to expand. Next, we'll go into 3 important dates when it comes to dividends, and you will need to make sure you understand what these 3 dates are. You may be asked, 1, to describe what these dates are. 2, you need to know how to do the accounting at each of these dates. And 3, what is the impact at each of these dates to the GL accounts? First, let's talk about the date of declaration. At the date of declaration, this represents a binding legal obligation to the company to distribute dividends. Therefore, you will record the liability for the dividend. We will go through an example of this shortly under number 3 there for types of dividends, and I will show you what I mean by recording the liability for the dividends. It is important to note that this is the date that they are legally obligated to distribute dividends when they make this declaration. Therefore, they are required to make the distribution. Therefore, they are required to establish a liability for those dividends. The date of record. The date of record is owners of the stock at this date are entitled to the dividend. Therefore, if you make the date of declaration on January 1st, payable on March 1st, but to stockholders of the date of record of February 1st, everyone that is a common stockholders as of February 1st is entitled to the dividend. The key thing I want to point out here is this: there are no accounting entries made at the date of record. In any type of dividend, there is no entry made. This is solely a liability legal aspect with the date of record, so owners know which owners know who's getting this dividend, and the corporation can allocate those dividends to the appropriate stockholders at a date and time. Lastly is the date of payment, and this is just simply the distribution of the dividend in which you would remove the liability. So before we move on to getting into some examples of dividends, I just want to reiterate that these 3 dates are key for you to understand as you're completing your problems for dividends. Specifically, making sure that you understand that the date of declaration is a binding legal obligation. I apologize. I am home today with my dog, and my dog saw a squirrel in the yard and has begun to bark. Just a little brief sidebar before we get back to the materials here. I do have a puppy. She is just about 1 year old, and she is a handful to say the least. Her name is Avery. So occasionally you might hear her in the background while I'm recording these lectures at my house. So before we move on again to highlight, you need to understand the importance of these 3 dates and what they represent. 1, the binding legal obligation is the date of declaration. 2, no accounting entries are made at the date of record. And then 3, the date of payment is just when they distribute the dividend. So let's go ahead and get into a few examples of the type of dividends that you are going to be responsible for understanding. First is the cash dividends. This is probably the simplest of all of the dividends that we're going to cover. So Royal Bats declared a $30,000 cash dividend on May 10th, payable on June 1st to shareholders of record on May 31st. So first, let's outline what we know. We know that they declared the dividend on May 10th. So May 10th becomes the date of declaration. June 1st is the date of payment, and May 31st is the date of record. And I will go ahead and move these in different orders here. So we're going in order of how we discussed previously. Okay, so as we just went over here, there's the 3 dates that we identified there, and this would be a good first step when you're going through these examples, is identifying what are these specific dates so you can keep track of the entries that you know you need to make. First, you need to record the entry at the date of declaration. Therefore, on May 10th, we know that they declared a $30,000 cash dividend. Therefore, we know from up here that we need to record the liability for the dividend. Therefore, we need to increase the dividend. We need to increase the dividend payable by $30,000. One thing to note here is that we are just declaring the dividend. Therefore, we are responsible for paying the dividend, but we will not pay the dividend yet. Therefore, we do not impact cash at this point in time. Therefore, as we discussed previously, that retained earnings is what drives the dividends. Therefore, that is what the retained earnings are coming out of, are the dividends. Therefore, we need to decrease the retained earnings by the $30,000. So that gets our first one done. Next, we need to go to the date of record, and I've noted it here for you, but remember, there are no entries made at the date of record. Therefore, you do not need to know anything in terms of accounting for them in these T accounts. You just need to know what the date of record represents. So step 2 is done. And the third step is payable on June 1st to the shareholders of record on May 31st. So now we need to record the payment. This is a cash dividend. Therefore, we will be paying the $30,000 out of cash. And we need to remove the liability. And as you can see, all of our accounts offset and they balance. That is what you need to know for cash dividends. Cash dividends are by far the simplest type of dividends that you will encounter as we go on here, but is the basic setup and is a good example of how you can apply the 3 key dates that we just previously discussed. Next, let's move on to property dividends. As I mentioned previously, owner transactions do not impact net income. However, property dividends can be the exception. It's not always the exception, but it can be the exception to that rule. However, for the most part, make sure you understand that owner transactions do not impact owner's equity. I will not try, or sorry, let me rephrase that. Owner transactions do not impact net income. I will not try to trick you by asking you that and not telling you that property dividends could be the example. And if I do, I apologize and that will be corrected. So just to briefly discuss what property dividends are. Property dividends are dividends payable in assets of the corporation other than cash. Make sure you understand that this is also known as dividends in kind. You may see that terminology on your assignment or the exam. So, to differentiate from cash dividends, where we used our cash balance to pay the dividends, in this example, we will be using something other than cash to reflect the dividend payment. The key thing you need to remember with property dividends is that before you record the dividends, you need to restate at the fair value the property you will distribute and then recognize any gain or loss. This is the circumstance where you could have an owner transaction impact net income. If the book value and the par value of the property you're distributing are different, then you will recognize a gain or loss, and that will flow through net income. However, if the book value and the fair value are equal to each other, then you will not recognize any gain or loss, thus it would not impact net income. So that is the circumstance in which a dividend owner transaction could impact net income. We'll walk through an example here to make sure that we understand that concept. So on February 1st, QuikTrip declares a dividend of free coffee that has a fair value of $2 and costs the company 50 cents. This dividend is paid on 3/15. So going back to what we know, the first step is we need to adjust the inventory balance to reflect the fair value. Then we're going to need to do the date of declaration, then the date of record, and then the date of payment. And this is how I would kind of think about each transaction when you're dealing with dividends, is making sure that you're hitting everything you need to at each of those key dates. So first, we need to adjust the inventory to reflect the fair value. So we started with a fair value or a balance in the inventory account of 50 cents. And this is the fact that that is the cost to the company for the coffee. One thing I would like to highlight, this example is very basic and it is assuming 1 cup of coffee. You could see a problem where it says QuikTrip declares a dividend of 500 free coffees, and then you would have to do a little bit additional math to figure out what the adjustment needs to be. But this is just in its simplest form. We're thinking of this as 1 share, 1 dividend, 1 cup of coffee. So first we need to adjust the book value of the inventory. We know the fair value is $2 and it cost the company 50 cents. So we know that we need to adjust inventory by $1.50. Therefore, we need to add the $1.50 to inventory, and that occurs on 2/1, which is the date of declaration. So at the date of declaration, we do have to record the liability. However, you do not record the liability yet. First, you need to account for this change in your assets that you increase your inventory. And for this example, what ends up happening is you recognize a gain of $1.50 because your fair value has increased by the $1.50. Next, we need to account for the date of declaration, which is 2/1. So you will also make an entry here on 2/1. Now you need to make the entry that reflects the recording of the liability and the removal of the balance from retained earnings, because that is what you are paying as a dividend. So first you need to establish your liability, the $2 payable, and then you need to remove that balance from retained earnings because you were paying the dividend out, and dividends come out of retained earnings. As you can see, while you took a $2 decrease in retained earnings, it is offset partially by the $1.50 in increase you received in fair value. Therefore, your net decrease to retained earnings is only going to be 50 cents. So now that we have gotten the date of declaration done, and as you can see, our accounts balance, we have this was already there. So our entry of 150 is offset here, and then our entry of 2 is offset there. So as you can see, we're all balanced going into the date of record. The date of record does not have any accounting entries. You have to make sure that you understand that. While I did not specify in this example what the date of record was, a problem you will see likely on a homework quiz or the exam will include that information. You just need to make sure that you remember that at the date of record there is no accounting entry. Lastly, the date of payment, which is March 15th. And now we need to remove the liability and reflect the outflow of the asset paying the dividend. So whereas in the previous example, cash was what we paid the dividend with, so we removed cash from our balance sheet. In this example, we're removing the inventory that is backing this dividend. Therefore, on 3/15, we need to remove the inventory because we're using the inventory as our dividend. So we're giving the free coffee out as the dividend to cover the dividend payable that we have of $2. And this just highlights what I've said previously about owner transactions do not impact net income with the exception of property dividends due to the fair value adjustment, as we did initially when we recorded the $1.50 increase in fair value. So before we move on, I just want to make sure that we understand how property dividends work. Your first step is you need to adjust the inventory to reflect the fair value. Therefore, in this example, we needed to go from 50 cents to $2. Therefore, we need to increase our inventory, which is a debit, and then offset that with an increase to equity, which was reflected through a gain, which hits net income and then ultimately flows in to retained earnings. Next, we go to our three-step approach for each date: the date of declaration, the date of record, and the date of payment. First, the date of declaration. So on February 1st, we know that we need to pay a $2 dividend for the coffee. Therefore, we need to establish our $2 payable and then offset that with a $2 decrease to retained earnings. Next, at the date of record, we know that there is no accounting entry made on this date. And then lastly, on step 4, the date of payment on 3/15, we have to remove our liability of $2 and pay out the asset that is backing the dividend. All right, moving on now. Now that we just got done discussing property dividends, let's move on to liquidating dividends. The key thing to note here, and I will stress this right here, this is a return of your investment, not on your investment. Most dividends are rewarding you for your investment. You put in money to the company, and as a reward for that, they pay you out money back. However, the difference here for liquidating dividends is they're not giving you a dividend on your investment. Therefore, they are not rewarding you for investing in them by giving you additional money in a dividend. What they are doing is they are taking that money that you initially put in and returning part of it back to you. So it's a return of your investment. That is key to note. That is a return of your investment, not on your investment. And what this essentially does is that the dividends that are distributed, so these liquidating dividends, they are distributed from the additional paid in capital accounts, which represent the balances from the investor when they purchase stock. So as we discussed previously, the additional paid in capital account represents the amount paid for the stock in excess of par. So what they do is and the example we've used previously where you paid $50 for a $10 par value, that $40 that goes into additional paid in capital, when they decide and declare to pay a liquidating dividend, they're going to pay part of that $40 back to you. Therefore, what it happens is these dividends are accounted for similar to cash dividends, so similar to this. However, instead of the debit entry being to retained earnings, you are going to decrease the additional paid in capital account. So it is the return of your capital investment will decrease the additional paid in capital account. Therefore, in this example here for cash dividends, instead of having this 30,000 be represented in retained earnings, it would be 30,000 hitting additional paid in capital. Therefore, before we go on, just to kind of show you how this looks in an accounting entry, so they would pay this out where they would have additional paid in capital, they would decrease, let's say 40,000, and then they would pay out the cash of 40,000. As you can see in this does not impact retained earnings. However, what I will note is what it says here in this last line. The remainder of the dividend will decrease retained earnings. So for example, let's say that in the additional paid in capital account, you only had $30,000. Then what you would do is you would decrease the additional paid in capital account by the 30,000 that's in there. You would debit the remaining 10,000 to retained earnings, and then you would have the cash out payment of $40,000. So this is very similar to how cash dividends are accounted for. The main difference is that you first will debit additional paid in capital for the entire dividend up to the amount that is in that account. If the additional paid in capital amount does not have enough in it to cover the entire dividend, then you have to reflect part of that balance in retained earnings as a decrease. What I will note here, and to make sure you understand that, the decrease in additional paid in capital, the debit entry, this is the return of your investment. A decrease in retained earnings is a return on your investment. So that is key to note. All right. Now let's move on. We just got done discussing liquidating dividends, and so hopefully you can keep that straight, the difference between liquidating dividends and how they differ from other type of dividends. And the main thing you need to remember is that is a return of your investment, and that you first will debit your additional paid in capital. Next, moving on to stock dividends. Okay, first, to give a brief recap here of what stock dividends are. They are essentially the reclassification of earned capital to contributed capital. So as we discussed in the first lecture for chapter 15 in that illustration where our capital our total stockholders' equity is made up of contributed capital and earned capital, whereas earned capital is retained earnings, and contributed capital is made up of our common stock, our preferred stock, and our additional paid-in capital accounts. So what this does with stock dividends is that it takes part of that retained earnings, the earned capital, and transfers it to the contributed capital accounts. It's key to note here that there are no assets distributed under stock dividends, and each stockholder will retain the same proportionate interest in the corporation. Therefore, there is no change in owner value. That is key to note for a conceptual standpoint of stock dividends. There's no change in the owner value whatsoever. You are essentially just reclassifying the earned capital part of equity to the contributed capital part. There are two types of stock dividends. There are small stock dividends and large stock dividends. Small stock dividends are when the stock dividend is for less than 20% of the outstanding shares. So if the example includes something that says they issued a 10% stock dividend, that means it will be a small stock dividend, also referred to as an ordinary dividend. Under small stock dividends, you have to take balances out of retained earnings. And when you do so, when you decrease retained earnings, you do so at the market price of the shares. This is where the difference between small stock and large stock is most significant. You need to remember, one, key things to remember, has to be less than 20% of the outstanding shares. And two, uses market price of shares for transfer from retained earnings. You have to make sure you know that, because you will be given an example in a question where it will specifically just state that the company ABC decided to declare a dividend of 15% stock dividend of outstanding shares. Therefore, when you go to do the calculations, you have to know that the amount you're pulling from retained earnings needs to reflect the market price of those shares. Large stock dividends are things that are greater than 20% of the outstanding shares. And when you do the transfer from retained earnings, you do so based on the par value of the shares. And it does so you will not impact the additional paid-in capital account here. So the key takeaway here for large stock is greater than 20%, and two, par value transfer from retained earnings. If you can remember these two differences between small stock and large stock, you should help you tremendously as you're going through the examples. I have broken it down. What I think makes it easiest to do is that there's multiple steps here. So in addition to the three-step approach we discussed with the date of declaration, date of record, and date of payment, there's also a couple steps here specifically that you need to consider for stock dividends. The first one is to calculate the number of new shares. So when we say a company issues a stock dividend equal to 10% of the outstanding shares, let's for example say that the company had 10,000 shares outstanding and they issue a 10% stock dividend. What this means is that you are going to be issuing new shares. So you are going to be issuing 1,000 new shares. This is the first step you must do. If you do not do this, you will not know how to account for the balances in the T accounts, because you will not be inputting the correct number. Because what could happen if you do not do this calculation, you may assume that you need to take 10,000 shares times the appropriate balances, and then you're going to have a significantly higher amount of balances being put into these accounts when they're not supposed to be quite as significant. So step one, always calculate this new shares. And this is the same method for both small stock and large stock. You just take the shares outstanding times the stock dividend percentage, and then that gives you the number of new shares. Then you will do the entries at the date of declaration and the date of issuance, similar to what we discussed with the three-step approach for the date of declaration, the date of record, and the date of payment or issuance. So first, let's do an example of a small stock dividend. Jayhawk Corporation has 50,000 shares of $10 par value common stock outstanding. Before we move on, let's highlight this. So we have 50,000 shares. We know the par is 10. The company declares a 10% stock dividend on November 3rd. On the date of declaration, the fair market value of the shares were $25. So those are the key information here. You need to know the shares outstanding, the par value, the percentage of the stock dividend, and the fair market value for small stock dividends. Do not let yourself be tricked in an example. I may give you an example of a large stock dividend and put the fair value number in the problem. You need to remember that the fair value number will not impact retained earnings because it is transferred at par value. So do not let yourself get tricked. The concept here is if you can make sure you remember how the difference between small stock dividends and large stock dividends, you should be able to do any of these problems. So first, let's go now into the entries that we need to make. So we know that we have 5,000 new shares, or 50,000 shares and a 10% stock dividend. Therefore, our first step is calculating our new shares. So we know that there are 5,000 new shares. Now what we need to do is we need to take these 5,000 shares and figure out how they impact the GL accounts. So first, let's do retained earnings since that's been our focus. As we discussed previously, for small stock dividends, and you know this is small stock because it is less than 20%, we need to transfer the balance out of retained earnings at the fair market value, and in this example is $25 per share. Therefore, what you're going to do is you're going to debit retained earnings, which decreases retained earnings. I did not include the little assets equal liabilities plus owner's equity for this example. These are all equity accounts, just so you are aware. So we established that we need to remove the 5,000 shares at the fair market value. So we decrease retained earnings by $125,000. Next, we need to reflect common stock for additional paid in capital and the common stock dividend distribution. This is important to note. This is not a liability account, but rather an equity account, and it's just establishing that you are going to be making a dividend distribution of common stock. This account is treated very similar to how a capital stock account for common stock is treated. Therefore, we know that we have 5,000 new shares as we calculated, and we know the par value is $10. Therefore, we need to increase this distribution account to reflect the par amount of what's being distributed, which is $50,000, 5,000 shares times the $10 par. Now we need to reflect the balance we need in common stock additional paid in capital, because as you can see, we do not currently balance. Therefore, we need to take the 5,000 new shares times $15, and that gives us $75,000, and therefore our accounts balance here. The key note here is the balance that you're doing to this account is the difference between the fair market value and the par, similar to what we did previously in our examples. As you can see, we have $25 for fair market value and a $10 par value. Therefore, the difference is $15 times the number of new shares, and that gives you $75,000. So this is key to note, as I mentioned previously, that this does translate throughout this chapter, knowing what goes into the additional paid-in capital account and what goes into the common stock and preferred stock capital accounts. These are all the entries that were made on the date of declaration. So these were all the entries that were reflected on November 3rd. Therefore, now we know what all of that is for the date of declaration. We know the date of record. There is no accounting entries made on any type of dividend. Now we need to actually pay the dividend. And then the dividend we're paying common stock dividend distribution account here. Therefore, at the issue date, we remove the $50,000 and we increase our common stock by the $50,000 at the issue date. So as you can see, we reduced retained earnings for $125,000 and we reestablished common stock and additional paid-in capital of amount equal to $125,000. So as I previously mentioned up here, there's no change in the owner value whatsoever, because all we did was transfer the earned capital of $125,000 and we transferred it to the contributed capital, which is the common stock and the common stock additional paid-in capital account. So a main key takeaway here is the basic understanding that we are reclassifying earned capital to contributed capital. Make sure that you understand that, because that will tremendously help you as you're going through the examples. And you can remember that we are taking balances from earned capital, which is retained earnings, and moving it to contributed capital. Therefore, our contributed capital balances at the date of issuance, after we issue the dividend, should equal, or should offset, I should say, the amount that we changed the earned capital. And as you can see in our first example, as we just went over, we decreased earned capital by $125,000 and we increased the contributed capital by $125,000. And this common stock dividend distribution account goes away because it offsets $50,000 and $50,000. That is the simple summary, I guess I would say, of a small stock dividend. I would not expect you to have anything too much more complex than this. The main thing I want to test you on with your homework, quizzes, and the exam with respect to stock dividends is making sure you understand the difference between small stock dividends and large stock dividends, specifically whether you use fair value or par value, that it is merely a transfer from earned capital to contributed capital, and then also that you can do one of these examples. Next, let's do an example of the large stock dividends. So using the same information we just did, now let's say that the stock dividend is 30%. So our first step is we need to calculate the number of new shares. So we know that we had, in this example, 50,000 shares outstanding, and we had a 30% stock dividend. Therefore, 50,000 times 30% equals 15,000 new shares. So at the date of declaration, we need to record the entries to reflect these new shares that are going to be distributed. So similar to small stock dividends, you will increase the common stock dividend distribution by the par amount, the $10. Then you will decrease retained earnings by the par amount as well. This is key to remember. The difference between large stock and small stock. Small stock, we did the transfer at fair market value. And large stock dividends, you do the transfer at par. As you can see, because we did the transfer at par, there is no impact to common stock additional paid in capital and large stock dividends. And that is because the amount of common stock dividend you're distributing is exactly equal to the amount you're pulling from retained earnings. So that is the only entries that have to be made at the date of declaration. At the date of record, we know there is no accounting entries. Therefore, at the date of issuance, all we need to do is remove this account. This is reflecting the fact that we are paying the $150,000 common stock dividend, and then we are going to increase our common stock. Therefore, going back to the concept of transfer from earned capital to contributed capital, we removed $150,000 from retained earnings because this is a decrease on the debit entry, and we increased through a credit entry to common stock the contributed capital of the company. And this is how you can see there's no change in owner value because this all merely offsets from earned capital to contributed capital. I hope that this has been a good discussion on stock dividends, and the key things I've pointed out will help you understand these examples. On the simplest terms is, remember, for small stock dividends you use market price of the shares, and when you do so you will have an entry needed to be made to a common stock additional paid in capital, and that is because there is a difference between the market value and the par value. For large stock dividends, you do the transfer at par, and therefore there will be no additional paid in capital account because the amount that you are recognizing for dividend distribution will equal exactly the amount of the impacted in retained earnings. Stock dividends, this is a key concept to understand. And at the end of this chapter, there are a few illustrations I provided that walk you through the entries that are made for certain type of dividends, and then also the impact on certain things that small stock dividends, large stock dividends, and stock splits, which we're getting ready to discuss here in just a moment, have on certain accounts, including owner's equity. Those illustrations will be great study aids and will definitely help you conceptually understand what is going on with these dividend transactions. Next, let's move on to stock dividends. Stock splits. Stock splits are very, very simple to understand, or at least I hope they will be. Essentially, all you are doing in a stock split is you are decreasing the par value per share and increasing the number of shares that you issued, and you do this proportionally. So as a basic example, company ABC has 1,000 shares of common stock with a $4 par value. So I've reflected this entry here, pre-split, the $4,000 representative of the 1,000 shares times the $4 par value. On December 1st, they announced a 2-for-1 stock split, which means 2 shares for every 1 share. This will be how I show all stock splits in your examples for your quizzes, homework, or the exam, is I will always say 2-to-1, 5-to-1, something of that nature. So you'll always know that it is the first number is the shares, new shares you're getting for every 1 share of the other. So to illustrate a stock split, you decrease the par value per share and increase the number of shares issued proportionally. Therefore, you're going, since this is a 2-for-1 split, you're going to get 2 new shares for every 1 share. Since we had 1,000 shares initially, we now go to 2,000 shares, so 1,000 times 2. But as we increase the number of shares, we have to decrease the par value per share. So we started at $4 per par value when it was 1,000 shares, but now that it's 2,000 shares, or doubled, we need to decrease in half the par value down to $2 per share. As you can see, the balance in the common stock account has not changed whatsoever. It is just merely a change in the structure with the number of shares and the par value per share. This is important to note. Stock splits do not change the amount recognized in equity, Make sure you understand that. That is a key concept which you need to know for stock splits. Next, let's go to restrictions on retained earnings. I think I touched on this briefly earlier when I went through the illustration in the first lecture about how there's an appropriated and unappropriated retained earnings amount. And all this is that a company could have formalized restrictions on how they use their retained earnings to pay dividends. For example, the company may establish restrictions that they have to keep a certain part of retained earnings segregated from the rest because they need these balances to fulfill creditor obligations or something like that. So all they do is they take the retained earnings balance, for example, of 50,000, they decrease it by 10,000, but then they just put this 10,000 in something called restricted retained earnings. So when you see total retained earnings shown on the balance sheet, it is always going to be the sum of retained earnings and restricted retained earnings. Therefore, this new balance here is 40,000. So the 40,000 plus the 10 equals 50,000. Therefore, you can see that there was no change in the retained earning balance. It's just rather a restructuring of it to reflect the amounts that they need to segregate. Next, let's go into the presentation of stockholders' equity. There is an example in your textbook of a comprehensive stockholders' equity section. This shows you how companies presented in their financial statements and their disclosures, and they make sure that they put certain rights and privileges of the various securities in there. So they have to detail a lot of information in these disclosures about what they're dividending, what dividends they have, what type of dividends they are, the liquidation preferences, as we discussed, creditors, preferred stock, then common stock, any specific rights, call prices, dates, any key information related to the company's stockholders' equity. I will not be requiring that you be able to prepare a comprehensive stockholders' equity section of the balance sheet, but I do want you to know what is required to make up the parts in this book or in this section, which is the stock, additional paid in capital, retained earnings, everything that we have discussed throughout this chapter. So you don't need to refer to the textbook to know what's in it because we've discussed what's in it in this chapter, but if you would like to refer to the textbook to get an understanding of how it's presented in financial statements, then please feel free to do so. And we are almost finished with today's lecture. I want to briefly discuss 3 ratios for analysis of stockholders' equity. If I ask you a question on the exam related to these 3 items, I will provide you with the formulas. If I do not provide them already on the exam, I will provide them the day of the test. The main thing I want you to take away here is not necessarily how you calculate each of these items, but the significance of specifically the return on equity, the first one, and the book value per share, and why they are significant to common stockholders. First, for retained earnings, it is important to common stockholders to know what the return on their equity is. What it does is it measures the profitability from the common stockholders' viewpoint. So it knows how much of their equity is profitable business for the company. Regarding the book value per share, what this allows them to know is that they know what each share would receive if the company were liquidated on the basis of the balance sheet. Therefore, why this is important to a common stockholder is they know that if the company were liquidated based on what's reported on the balance sheet, their share would be worth so many assets. And then they can use that to determine how valuable that share is to them. And then the payout ratio just reflects what the cash dividends are to the net income and what percentage of net income the company is paying out in cash dividend to the common stockholders. Again, if I ask you how to calculate any of these, I will give you the formula, but the main thing I want you to know specifically for book value per share and return on common equity, I want you to know the reason why it's important for common stockholders, why it's an important analysis tool. All right. One last little bit here. First, before we dive into some illustrations here, I want you to make sure you understand how the transactions outlined in this chapter impact the various components of stockholders' equity. Not only do you need to be able to calculate the problems that I provide, the computational part of this, you need to understand the conceptual part of these transactions and how they impact the various components of stockholders' equity. When we issue new stock, what increases, what decreases? When we have a dividend, what increases and what decreases? Making sure you understand that is extremely important. On the next few pages of your lecture note packet, I've included a few illustrations that just kind of show you. First one is the sources of change in equity. So this just shows you kind of what changes for these type of transactions. This one, summary of the dividend entries. This shows you what entries you're making at each of those three important dates that we talked about. This is a very useful tool to remember. I would use this as a very important study aid because this will not only help you in completing the problem and knowing what entries to make into the GL accounts, but this will also help you conceptually understand each type of these dividends. And for purposes of our class, small stock dividends will always be less than 20%, and I will always make large stock dividends greater than 30%. So this table makes it, appear that 25% falls into that range, but I will make it very clear. It'll be very obvious if it's a small stock or a large stock dividend. And the last illustration I have here is the effects of common stock dividends and stock splits on stockholders' equity. This is an extremely important review material as well. This will conceptually help you understand how each of these type of transactions impact total equity, par value per share, total par value outstanding, retained earnings, additional paid-in capital, number of shares. This just helps you understand what are the moving parts in each of these transactions. The key thing to note here is that all three of these do not change total stockholders' equity. None of them do. That is extremely important to know. The other key thing to note is that for common stock, you can see it largely does not impact anything. Does not impact stockholders' equity, does not impact retained earnings. All it does is change the shares outstanding and the par value per shares. Well, that is all I have for the third lecture of chapter 15. Let me see. Let's go back to the very beginning that we just started discussing today and make sure if there's anything else that we should note before we exit this lecture. We have gone over the significant parts of preferred stock earlier in this chapter and the things I wanted you to remember. Make sure you understand these three important dates. Make sure that you understand that for property dividends, you need to adjust the value of the property you're distributing to fair value. Liquidating dividends are a return of your investment, not on your investment. Stock dividends are a reclassification of earned capital to contributed capital. Small stock dividends, the transfer from retained earnings is at market price or market value. The transfer for large stocks dividends from retained earnings is par value. Stock splits do not change the amount recognized in equity. It's just merely a transfer in the number of shares and the par values allocated to those shares. The significance of the ROE and the book value per share analysis tools for common stockholders. And then also making sure you understand how each of these transactions in this chapter impact the various components of stockholders' equity. That is all that I have for today. This is the end of chapter 15 lectures. Posted to Desire to Learn is your chapter 20 lecture. For the first exam, you will only be required to know chapters 15 and chapters 20. for that exam. And as you can tell, once you get into the Chapter 20 lecture, I have kept it at a very high level. So most of your test homework quizzes will be derived from Chapter 15 material for this first exam. So if you had to place an emphasis on which chapter to know better than the other, it is definitely chapter 15, as there are a lot of moving parts related to this chapter. Now that you have listened to the 3 chapter 15 lectures, I would encourage you to start working on your homework and referencing this note handout packet as you go along. Please also feel free to use the textbook to try to enforce these concepts and to aid you in the completion of your homework. I will work on trying to post some additional practice problems for some of these transactions prior to the first exam, and even put together an exam review booklet once I have figured out what exactly will be on the exam. Remember, your first exam is February 29th and will be held on campus. I will provide additional information regarding the specific time and location of that prior to the first exam. That is all for today, and please take your time doing your homework, and please ask me any questions if you that come up as you're completing it. The intent of the homework in the quizzes is for you to receive as many points as possible. I've tried to structure where I can grade them and give you as much partial credit as possible, but I also feel that they are structured in a manner that, one, will allow you to receive most of your points, if not all, and two, will help reinforce some of the conceptual components that could often be difficult to understand in this chapter. So please let me know if you have any question over this material. Otherwise, have a good day, and I look forward to seeing you at the first exam.